Okay, let's get straight to it. Today, the purpose of this demo is to show you how to set up the books for an entrepreneur with a small company. Our demo company today is My 5 Cents, and the owner of My 5 Cents is Bob Kunamuna. Okay, the first thing we're going to do is set up a chart of accounts. This is step one. And you could set up a generate chart of accounts with your cash, all your assets, your liabilities, your capital, your revenues, and your expenses. Those are your 5 main account groups. Number 1, your assets. Number 2, your liabilities. Number 3, your capital or equity section. Number 4, your revenue. And number 5, your expenses. So some of the generic accounts for the asset group would be cash, accounts receivables, prepaid assets, inventory, and so on and so forth. For liabilities, you have your accounts payable, your unearned revenue, short-term payable, liabilities, and so on and so forth. Then in this case, for the capital or equity section, you have Bob Kunamuna Capital and got Bob Kunamuna withdrawals. Show right there. Okay. For the revenue section, you just have revenue and interest income if you had some investments sitting in a bank or sitting in another company's balance sheets. You have interest income as well. And then you also have your expenses. And if you're an inventory company, one of your major expenses would be cost of goods sold. And then you have all your other expenses such as office rent, your supplies expense, your repairs expense, and so on and so forth. So that's the first thing you do. You set up your chart of accounts. Very simple. That's step 1. Also, each account has an account number. Remember, there are 5 main groups of accounts: your assets, your liabilities, your capital/equity, your revenue, and your expenses. One good way to have a well-organized chart of accounts is to have each group of accounts actually categorized by series. So for example, in this case, we have your assets, and they are the 1000 series. The accounts payable, the liabilities group of accounts are 2000 series, and capital/equity are 3000s. The revenues are the 4000s, and the expenses are the 5000s. That way you can keep them well organized. And then you just want to list all your assets under, that designated series. For example, cash is 1001, or accounts receivable is 1002, and so on and so forth. And preferably you would list these in numerical order. You wouldn't want to jump from accounts receivable as 1002 and then list prepaid assets as 1010 and then list inventory as 1012, and just having all these gaps in between. So preferably just go in order uniformly. Keeps things well balanced and keeps you this keeps a well organized chart of accounts. Alright, so that's the first thing you do: prepare a chart of accounts. Pretty straightforward, pretty easy to do. Okay, so your second step is to prepare a trial balance. A trial balance is a way of checking to see if all your debits equal all your credits. You do this step before you even begin to actually prepare your financial statements, and you summarize all your account balances with all the transactions that have taken place before you start setting up your financial statements, and you put them in their respective columns: debit column, credit columns. Your assets and your expenses, they normally have a debit balance. Your liabilities, your equity, and your revenue, they usually have a credit balance. When Bob started up the business, he started up with a $15,000 truck that he had saved up for. He started up the business with $2,500 worth of inventory. $1,500 worth of inventory he came from his own pockets that he had saved up for over the years, and $1,000 of it was actually bought on credit. So he owes that amount to creditors. Bob also made a $10,000 loan from the bank. It's a 5-year loan, and he used that loan to pay off his rent expense and other operating expenses and administrative expenses and his other miscellaneous expenses. And on a good note, Bob also had sales upon starting up the business. He had sold 2 laptops but had not gotten paid for them as yet. So he had made sales of $1,250, just awaiting monies, cash receipts on those sales. Alright, so to set up this into a trial balance, here is a $15,000 truck. It's an asset, so it's a debit balance. The $2,500 worth of inventory, again, that's another asset, so that's a debit balance. $1,500 of it was out of his own pocket. $1,000 of it he actually owes for. He owes it to creditors. Liability, so it's a credit balance in the credit column. He made a loan for $10,000. He owes for that loan. It's a liability. It's a long-term liability, so it's in the credit column. With that, he paid various expenses, including office rent expense, supplies expense, repairs expense, licensing fees, advertising expense, utilities expense, and communications expense. All expenses usually a debit balance, so we place those in the debit column. After subtracting all those payments from that $10,000 loan, okay, it leaves Bob with $8,630 in cash. Cash, that's an asset, so it's in the debit column. He had sales. He sold 2 laptops upon starting up the company that he had not gotten paid for as yet. So that's $1,250. Accounts receivable, which is, in other words, all monies owed for credit sales or sales that you have made to customers on credit. Alright, all things being equal. So that's an asset, that's $1,250 in the asset column, and sales for that same $1,250 in sales revenues usually carry a credit balance, so that goes in the credit column. And finally, Bob's capital is equity, and again, capital and equity, they're usually credit amounts that goes in the credit column. So remember, assets and expenses, you normally carry a debit balance that goes in the debit column. Your liabilities, capital/equity, and your revenues, they normally carry a credit balance, so they go in the credit column. Okay, $16,500. How do we come up with that? $15,000 truck, okay, plus $1,500 worth of the inventory that he actually owns, came out his pockets that he had saved up for out the years. So that's his equity. That's his fully owned. Okay. The next $1,000 worth of it, again, like we said, was on credit. So he doesn't really own that yet. He hasn't paid for it as yet. It's a credit balance. Anyways, so the 15,000 plus the 1,500 of the inventory gives you 16,500 capital. Add both columns up, and as you can see, we are in balance. $28,750 debits, $28,750 of credit. All right, so there goes. That's it for preparing a trial balance, and we're good to go. Move on to the next step. All right, before we actually get to preparing the first financial statement, which is the income statement, I actually did a loan amortization schedule just so that Bob could see, what his monthly payments are for that loan. It's a $10,000 loan for 5 years or 60 months at 3%. So this schedule shows his monthly payments, but it also shows the portion of the monthly payment that goes to principal and the portion that goes to interest over the life of the loan. Every year he would sum up the interest, all the interest paid throughout the year, and he could write it off as interest expense on his taxes. So that's a good thing to keep up with and to know for tax purposes. And it also goes on his income statement as well as interest expense. Whether he let it accrue yearly or whether he pays for it right up front, every month as the months go by, strictly with a cash and a interest expense double entry transaction. Okay, so, and also when you have a loan that's like a 5-year loan, a long-term loan, the portion of that loan that's due the first year would be your short-term portion, your short-term liability. The portion of the loan that's due beyond, a year's time, at the remaining 4 years of the loan, that would represent your long-term liability. So this also lets you, it also gives you the opportunity, it gives you a way for you to distinguish, your short-term liabilities versus your long-term liabilities, and for you to book them accordingly. Why would you want to do that? Well, a lot of times if you're calculating financial ratios, for example, let's say you're calculating your current ratio, which is your current assets divided by your current liabilities. Well, your current ratio could be overstated if you don't have any current liabilities, or if you have an amount in current liabilities that's less than actually what it should be. Then your current ratio could be over. If you have a current ratio of 3 to 1, what you were saying is that for every dollar of current liabilities, you have $3 of current assets to pay off those current liabilities. When in fact your financial ratio, your current ratio should actually probably be 2 to 1 or 1.5 to 1, which is saying that for every dollar of current liability, you only have $1.50 or maybe $2 to pay off those short-term liabilities. So, as your company expands and you get into filing with the SEC and you change into a corporation, you grow into a corporation, you change status, you're now a incorporated company, and you have all these different guidelines, rules, requirements that you have to follow according to the SEC. These are things that you are required to be very transparent with, so that outside investors and the banks and everyone who has an interest in your company can make well-informed decisions, whether to invest in your company, whether to buy your stocks, whether to, float a bond with you, whether to loan money to you, and so on and so forth. And all these things are looked at to make a good informed decision. And you want to be as transparent and straightforward as possible. So that's why I do this. Loan amortization schedule as well, and get in the habit of actually separating up long-term liabilities into short-term and long-term portion, and so on and so forth. Because in the future, that's my idea. That's the direction that I want to head in. It's actually grow and not just stay at the entrepreneurship level, but actually get into bigger and better things, into being incorporated and probably be on the New York Stock Exchange and get a piece of Wall Street. All right. And so that's it for this section of loan amortization schedule. All right. So with that, we begin with step number 3, which is actually getting to prepare your financial statements. And the very first financial statement you prepare is your income statement. So we did the chart of accounts, we did the trial balance, and now here we go. And we also did the loan amortization schedule, which is a side note. So here we go with step number 3, preparation of the income statement, the very first of the 4 financial statements, external financial statements. You have in this order: your income statement, statement of owner's equity, balance sheet, and then your statement of cash flows. All right, so we're beginning with the income statement. Pretty straightforward, pretty simple. It's my 5 cents. That's the name of the company, the income statement, and it's for the month ended December 31st. So it's for over a period of time. Okay. Again, we have revenues, sales, and we had discussed before. $12.50 is what he made. He made these sales before he even got the company started. Still haven't gotten paid for them as yet, but still counts as a sale according to GAAP, generally accepted accounting principles. Okay, which all financial statements and all business, all accounting rules, guidelines have to follow. It goes back to. All right, so sales of $12.50, and we have all the operating expenses, as we had discussed before, listed there for a total of $13.70. So we have a net loss of $120. Not bad. Pretty typical, actually, for the new companies that are just starting out. You start out in the red, you start out making a loss. This is nothing unusual. But again, as far as an example of that misleading, scenario that I just explained, things can be misleading, and that's why you're trying to be as straightforward and clear-cut as possible. Look at this example here. You have net income, it's a net loss actually of $120, but yet your cash position, according to the trial balance, was $8,630. Well, we'll see when we get to the balance sheet how the assets or the financial position of the company looks real fine and dandy. But if you look at the income statement, it's showing a loss, a net loss. So you got to look at both, or you got to look at all statements. Definitely the income statement and the balance sheet, look at both of them to actually get a good idea of the company. Okay, so that's it for income statements. Pretty straightforward, pretty simple. And as we move on, and the next month goes by, and the next month goes by, and so on and so forth, and the business begins to grow, it's going to start to get a little bit more and more, complex. It's not going to be this simple and this straightforward. This is as simple as it gets, guys and gals. This is as simple as it gets. Okay. Okay. So we move on now to The second financial statement, the statement of owner's equity. So again, just to recap, we went through a chart of accounts. Very first thing you do, set up a chart of accounts. Secondly, we went through a trial balance. And then as a side note, we went ahead and did the loan amortization schedule. And then we went through to step number 3, the first of the 4 financial statements, which was the income statement. And now we're here at the second of the 4 financial statements, the statement of owner's equity. So again, the company name, I5 Cents, statement of owner's equity. And this is for the month ended December 31st. So again, it's for over a period of time. This basically summarizes all the changes in owner's equity over that period of time. So again, it captures an updated balance, if you will, of the capital account. So the opening balance for Bob's capital was $16,500. Generally, your net income would increase your capital account, and your net loss would decrease your capital account. Other ways to increase and decrease your capital account would be like if you brought in new investments or new assets into the company that you either had just laying around in your for personal use, you enter it into the company, then that would increase your owner's equity. Or if you had gifts, someone gift you some assets or some funds, some cash, and you enter that into the company, that would increase your equity in the company. Also, if you make a lot of withdrawals, or you make any withdrawals from the company, that would, conversely, that would decrease your equity in the company. So basically, that's what sums up your statement of owner's equity. So again, you started out with $16,500. You had a net loss of $120, and now you are at your ending balance for your capital account, $16,380. So Bob Kunamuna Capital, December 31st, 2013, $16,380. Again, I'm going to redo this all in using a actual accounting software, QuickBooks Pro, the software of choice. Very, very great accounting software for small businesses. Because this is actually manually done in Excel, in a spreadsheet, and it could be a little bit time consuming. Because you would have to go through this each and every month, each or every time you prepare your financial statements. You would have to go through all the manual setups, all the manual entries, redo new financial statements, and so on and so forth. Meanwhile, in QuickBooks, when you set them up, you do the initial legwork and you do all those manual entries, and as you continue along recording entries, your financial statements are automatically generated and updated according to each transaction that you record, throughout the life of your business. And so it makes it a whole lot easier. And that's what computerized accounting does. So that's the way you want to go, if you're going to be really doing this or doing your books for the long run. It's very worthwhile. So I'll show you how to set that up using an actual accounting software. But this is just to go through the basics, go through it manually. So to break it down and explain, you could really see what happens even when you choose to go computerized to a computerized accounting software. You understand what's going on in the back screens. All those automatic calculations, you can understand where they're coming from and how they get calculated. So that's what this does. Alright, so again, that's it for the statement of owner's equity. Alright, the third financial statement is the balance sheet. Alright, now this one is for a specific period in time. So you have the heading My 5 Cents, the name of the company. And you have the balance sheet, and then you notice it's as of December 31st, 2013. Not for the period ending December 31st, 2013. This shows you a snapshot of the current financial position of the company. Okay? It doesn't sum up what happens over a period of time for a specific period of time. This is ongoing, forever going. At any point, you could stop and check what the financial position is of the company. That's what your balance sheet shows. It shows that specific moment in time. Okay? And the cardinal rule is assets equal liabilities plus capital. Okay? And pretty straightforward. You have your assets on one hand, you have your liabilities and capital on the other hand, and you list the account balances. Going to your trial balance, you have the cash at $8,630, accounts receivable at $1,250, your inventory at $2,500, your vehicle and equipment that you brought into the company at $15,000. You have $27,380. Okay, and the liabilities and capital section of the accounts payable, which is $1,000 of the $2,500 inventory that he brought into the company. $1,000 of it for which he still owes, that goes in under accounts payable. And then you have the 5-year loan payable line item, and that's a $10,000 balance that goes into that account, the loans payable account. So total liabilities of $11,000. And then we have the capital section. This can be done two ways, a couple different ways. Okay, I could have just went over to the statement of owner's equity, got Bob's ending capital balance, $16,380, plug that number into Bob Kunamunu capital, $16,380, boom, done deal, and there we have it, a balanced balance sheet. But when I went ahead and actually broke that capital section down, just to itemize it and show how we actually come up with the $16,380. Retained earnings, that's what your retained earnings line item is actually about. It's an accumulation of your net income. Okay, so generally speaking, so we didn't have a net income, we had a net loss of 120. So retained earnings, the 120. Bob Kunamuna capital, 16,500. Okay, so Bob Kunamuna updated or ending capital come December 31st, 16,380. And now we have total liabilities and capital, that's 27,380. So if you notice this whole little section, here, okay, that's actually your statement of owner's equity section. So if I prepared this first, I could have just used this here and generated a statement of owner's equity using just this information, just instead of having capital here, change the heading, statement of owner's equity, plug in the time period for the period ending, okay, plug in the name of the company, and voila, we have a statement of owner's equity, financial statement done and completed. Okay. And I get in the habit of doing this because as you go ahead and you incorporate and you become a corporation, you are required to have a retained earnings section in your equity section of the balance sheet. But as for small business and sole proprietorship, you can, you don't have to. you're probably better off just to do it the traditional way, which is just to use the one balance that you have from the statement of owner's equity and plug that amount in here into the capital section. And I say that because, for instance, like if this was a partnership, okay, and you have 5 partners in the partnership, okay, you would have to list each partner's capital on a separate line item. So you would have Bob's capital, I don't know, Rand's capital, Alex's capital, George's capital, and John's capital. You would have to list all those capitals in separate line items. But the thing is, each partner gets a share of that retained earnings or that net income. So then you would have retained earnings John, retained earnings Bob, retained earnings George, and retained earnings Alex, and whoever, and on and on. And that would just be a huge capital section and just, complicate things a little bit. So instead, just have a short and summarized capital for each partner. And that way you could just have one line for each partner. So you would have Bob's capital, you would have John's capital, George's capital, John, and so on and so forth, just within the one updated balance plugged in from doing the statement of owner's equity. Okay, which would show each partner's breakdown as well and show their updated balance for that period. Alright, and you just plug that in here rather than separating it up with retained earnings for each, just making it look complicated and all jumbled up. Okay, so that's it for the balance sheet. Pretty easy. Again, like I said, this is as simple and as easy as it gets when you're first starting out. As the months go by, a month go by, another month go by, and so on and so forth. It becomes a little bit more and more complicated. You'll start having things like accumulated depreciation here. You'll have depreciation expense on the income statement. You'll have interest expense on the income statement. Okay, the balance of the payables, the loan payables start going down as you pay that balance off. So all these things start to take effect as the business goes on. And as the business grows and as more transactions and more transactions and more transactions start coming up and popping up. Alright, that's it for balance sheet. Alright, so we're here at the fourth and final financial statement, the statement of cash flows. We have the name of the company, My 5 Cents, statement of cash flows, and this one is for over a period of time as well. So for the month ended December 31st, 2013, the statement of cash flows is very similar to the statement of owner's equity. So it shows all activities that affected that specific account and how we arrived at the ending balance for that account over that period of time. Very important statement. Your most two important statements are your income statement and your balance sheet, and I would say your statement of cash flows come as your third most important financial statement. But definitely your balance sheet and your income statement, those are the main two financial statements. So back to the statement of cash flows. There are 3 sections: operating activities, investing activities, and financing activities. In the operating activities, we are reconciling net income to show all cash, to show it on a strictly cash basis. So net income is usually made up of non-cash expenses and also non-cash revenues. So we're actually making net income strictly a cash basis amount, if you will, and also accounting for any of the short-term or operating activities of the company, the day-to-day activities of the company, where cash is involved, all the cash inflows and all the cash outflow. Right. So we have a net loss of $120. Okay, included in that net loss was a credit sale for $1,250. We didn't actually receive money for that sale. It's a credit sale. So we subtract that $1,250 from the income, the net loss in this case. Okay. As far as inventory and accounts payable goes, we sum this up by saying a lot of short-term assets give rise to short-term liabilities. Okay. And short-term transactions of short-term assets and short-term liabilities, those are actually operating activities, and this is the section that they fall under, operating activities section. When you net those two, short-term assets and short-term liabilities, or I should say when you net the short-term assets with their corresponding short-term liabilities, then you get the actual cash portion of those operating activities. Okay, whether cash was either increased or decreased. In other words, whether there was a cash inflow or a cash outflow regarding those operating activities. Okay, so we have an increase in inventory. Let's assume that you paid $1,000 for that inventory, and this is aside from the opening balance of what actually came out his pocket of that he put into the business. Okay, remember $1,500 of it was actually his. He came into the business with that. $1,000 extra was what he got on credit, okay, to establish the inventory for the business. So we're talking about the portion that's aside from what he started out with or what he had that came from his pockets. So increase in inventory of $1,000. It's assumed that he paid $1,000 for that inventory. Normally would be assumed that he paid $1,000 for that inventory. Okay. On the flip side, okay, the short-term liability, the corresponding short-term liability for that inventory would be accounts payable. An increase in accounts payable, now putting the two together fully tells the story. An increase in accounts payable means that money didn't really leave your hand for that purchase. Okay, you bought it on credit, so you add that $1,000 back into net income. Now, when you net the two, like I was saying, you net the increase in inventory, a short-term asset, and an increase in accounts payable and short-term liability. Okay, one was a subtraction, one is an addition. When you net the two, that's zero, and that tells the full story. $0, zero cash was exchanged, okay, in that operating activity or in that transaction, which is true. You know, he didn't pay for that $1,000 worth of inventory, and zero cash actually left the company for that operating activity, which falls in there and it tells the full story. All right, so we move on and say another example before I move on. What if you had prepaid assets? Okay, normally the journal entry for a prepaid asset, let's say you had prepaid supplies, you would debit prepaid supplies, okay, and you would credit cash. Now, increase in short-term assets shows as a subtraction in this section of the statement of cash flows. So, okay, so let's say he paid $1,000 for some prepaid assets. You would have the prepaid assets, an increase in prepaid assets showing as a subtraction $1,000, and there is no corresponding short-term liability to that prepaid asset. The corresponding account that was affected was cash. He strictly paid cash. Okay, so there's no increase in no short-term liability here, and the only thing that would be remaining there would be that increase in prepaid asset, which would show as a subtraction. And that is true. because that reflects that $1,000 was actually paid. Okay, so there was actually $1,000 cash outflow due to that increase in prepaid assets, and that would be sitting there alone as a line item without a corresponding short-term liability. And you net the two, it tells the full story. Okay, so that's what we're doing here. Captures all the operating activities of this section. All right. Then we have the cash flows from investing activities, and in here you would have all your investments, investment activities. Whether you purchase land, equipment, building, vehicle, all those are investments into the company. So that goes in the investing activities. Or on the flip side of it, whether you sold land, equipment, building, vehicle, and that would fall under here in investing activities also. All right, now we move on to the final section, the cash flows from financing activities. This section deals with how the company finances its long-term obligations, okay, or long-term goals. Yeah, so we have the long-term notes payable showing up in this section. Bob made a 5-year loan with the bank for $10,000. That shows up in this section. Other things that would show up in this section would be if he had a bond, okay, and he floated a bond for $50,000, that would be financing activity. Or the sale of stock, that would also be a financing activity. Okay, so all these long-term obligations and the long-range, long-term financing, long-term goals of the company, such as growth. The company is trying to grow, so they would, sell, put out a sale of stock or float a bond. Those are all financing activities. All right, and so when you add it all up, you total it all up, it shows a net increase, decrease in cash, which is the ending balance of the cash account at the end of December 31st. Okay, so that's it for the statement of cash flows. Very important statement. Looked at it a little closely, and it tells you more about the well-being of the company. So one quick example to show the importance of the statement of cash flows, okay? Well, let's say you're looking at a company that you want to invest in, and you're looking at 5-year financial statements for that company, and you're looking at the balance sheet. Just taking a quick look at the balance sheet, and you notice from year to year to year to year how the assets are increasing. So you're thinking, oh, this business is thriving, and it's an up and coming business, and it's, the assets of the company are great. It's a great business to invest in. Okay, so you see the balance sheet and total assets just keep increasing, and you're seeing the vehicle and all the long-term assets going up, and the company's cash account is real healthy and strong, and you're thinking, okay, great, business is good. You would throw some money into that company, or invest in that company. You just a quick glance at the assets. You're an assets person. Well, you look over here at the statement of cash flows, and you notice that in the financing activities section, there's a bond floated for, let's say, $100,000, okay? And here in the investing activities section of the statement of cash flows, there you see all the major purchases listed. The purchase of the land, the building, equipment over the years. If you, as you look at all the different statement of cash flows over the years, so it shows, or it tells you, it gives you a better picture of how the company actually came up with the money to purchase those assets, and how it tells the true story of how the company's balance sheet looks so good, or is looking so good over the years. And you notice it's not actually monies from revenues or from operations of the business, but it's actually money from financing activities of the business. Okay, the company owes for all that stuff, for all those increases in assets, and in the long run, they got to pay those monies back. So yeah, it's just like related in relation to life. You would see someone with a huge house, and a fancy car and all, but you don't really know how they how they got that huge house and that fancy car and all. It could all be owed for, and without paying for those things over a period over the years, you could end up homeless, or going bankrupt or whatever. So it's the same way for a company. Okay, so this statement of cash flows puts things in perspective. Okay, and gives you a better picture of the company. Okay, of the financial health of the company, the financial well-being of the company, and the overall well-being of the company. All right. So that's it for the statement of cash flows, and we could read more into that analysis and a whole lot more angles, that all of these statements could be looked at from, as far as analyzing. All right, so that's it. There you have it. How you set up the books for a sole proprietor with a small business. We did all 4 financial statements. We did income statement, the statement of owner's equity, the balance sheet, and we just wrapped up the statement of cash flows. Okay, so moving forward, like I said, we're going to get into how this is done using an actual accounting software. The accounting software we will be using is QuickBooks Pro, and I'm going to show you how to set all this up using QuickBooks Pro. I hope you all had a happy holidays, and I wish all of you a happy, blessed, and prosperous new year for the 2014. May all your business dreams come true. All right, until next time, be blessed. SVE, forward.